Well, greetings, my beloved clients and friends. It's been a few weeks since we last spoke. So I wanted to give you an update, getting close to the end of the year. And we had an eventful week this week. And that was on Tuesday. The CPI came in, which was the Consumer Price Index, or an indicator of inflation. And on Tuesday and Wednesday, the Federal Reserve met for their last meeting of the year. And on Wednesday, they announced that another rate increase. So I wanted to talk about that. And so on Tuesday, the inflation number came in more mild than expected, which is good. If inflation, as long as inflation stays very hot or high and elevated, the Fed is going to aggressively raise interest rates in an attempt to slow down the economy. But if inflation starts moderating, then the Fed could ease off, and that's the market's hope, and that's our hope for as investors. So it came in not too hot. It was up 0.1% month over month, which on an annualized basis is 1.2, which is really good because the Fed's target is about 2%. So we want to get back towards there. And as a result, not only of that, but considering other conditions, the Fed raised rates another 0.5%, which is less than they had done in the previous four meetings. In the previous four meetings, they had raised rates 0.75% each time. So they're moderating their pace of interest rate increases, and Powell said we needed to act quickly, and that's why we did those 4 rate hikes that were so aggressive, and so we're moderating that now. The need to act quickly, he said, is kind of past us now. Now it's more of a sustainable thing and to watch. So on the surface, that would sound like good news. And so the market didn't take a big hit, a little bit, but it didn't shoot way up either. And so I think it was in reaction to what he said. And so he reiterated what he's been saying, and it's like the market's been hopeful that he didn't mean what he said, but he does mean what he says, that he is determined to bring about price stability, meaning he's determined to get rid of inflation. And if it means slowing down the economy, if it means increasing unemployment, if it means bringing the economy into recession, he's okay with all of that, because his biggest priority, his only priority right now, is to get inflation under control. And when he talked about inflation, he said, you know what, it's kind of getting in under control, with the exception of one area. So, you know, housing isn't red hot anymore, and you know, energy prices have moderated, and but the one area that is problematic is the labor market, and that's what Powell said, and that's the part that he wants to get back into control. But it's also the part that the tools that he has is least effective in that area. Okay, so here's the problem. There's a labor shortage. There's more work right now in America than there are workers to do the work. Okay, and he says we have a structural labor problem, meaning it's not easy to fix because there's fundamentally more work than workers. And he pointed to a couple of reasons. One being that the baby boomers are retiring, and they're retiring early, and so we're losing a lot of that labor. And the millennials aren't feeling, stepping up to take those jobs. We just don't have enough people. In COVID, in America, over 1 million people died, and about 500,000 of them were in the labor force. So we lost 500,000 workers, and the previous administration had a very tight immigration policy, and the current administration has continued with a tight immigration policy. So we have a shortage of workers, and it's not an easy fix. Actually, it could be an easy fix, but the two solutions that would make it an easy fix, one, Powell has no control of, and two, it's very unpopular. Here's how we could fix this labor imbalance. Number one is loosen up our immigration policy. If the United States would say, no, we're in a labor shortage, we're gonna let people in that have the skills that we need. We're gonna do this temporary window that we're gonna let in 1 million people that have the skills that we need. They could fix that, but that would be extremely unpopular, and probably won't happen. The second thing that they could do is, the largest employer in the economy is the government, and the government could say, we're going to lay off 1 million workers. And so now those 1 million workers would end up in the labor force, and they'd have to go get private sector jobs, and they would alleviate that debate. But imagine that will never happen. That would be extremely unpopular. It would never happen. Those two would be easy fixes, but don't even think about them because neither one of those are going to happen. So the only alternative is for the Fed to try to do it. And here's the problem. The Fed has one tool in their toolbox, and that is interest rates, and more specifically, short-term interest rates. So the only thing that Powell can do is raise interest rates, and it's a very imprecise way to get to the problem. If the problem is a labor shortage, so how would raising interest rates ultimately fix the labor shortage? Well, as he raises interest rates, he's going to put some companies out of business. Companies that need capital intensive companies that have to borrow money to keep their business going. Their cost of capital is going up. A year ago, they could borrow at very low rates, depending on their credit, 0, 1, 2, 3, 4%, right? And so if their business generated 5, 6, 7, 8% returns, then that was positive. That was a net pot. It made sense for them to borrow at that rate, because their return on capital was higher. But now if their cost of capital goes to 5, 6, 7, 8%, and they're only making 5, 6, 7%, it doesn't make sense for them to stay in business. And so they'd have to go out of business and lay off their employees. And now we get to as a lot of companies start going out of business because their cost of capital is too high, then the labor market comes back into equilibrium. So it's a very ugly and brutal way to fix the labor shortage, but that's the only tool he has. It's like a dull knife. Imagine trying to cut a tomato with a dull knife. you just make a whole mess of that tomato, right? It just gets mushed and not cut. Or trying to cut meat with a dull knife, or bread, or trying to cut with dull scissors, right? You just make a whole mess of things. And that's really what Powell's only option is to try to fix this labor imbalance with a dull knife. Because until the labor market gets in balance, companies are forced to pay up for labor because there's not enough. So they have to entice these few people that want to work by raising the wages, right? And that's called wage inflation. And they don't want to lay people off because they're afraid that if they lay somebody off, they're not going to be able to find someone to replace them, right? So companies are keeping people around, and they're paying up to hire because there's a labor shortage, right? And that leads to inflation because people are making more, they spend more, they pay more for the stuff they buy, right? So that's the big structural problem. And it's, like I said, it's not an easy fix. And the Fed's tool is like a dull knife. So that's not good news. I mean, to be perfectly frank with you. And so how has it impacted the markets? Well, one thing is companies, when interest rates were at zero, it made sense for investors to invest in high growth, high future growth. Companies that, hey, the payoff is in 5 years or 10 years. And maybe in the meantime, they're burning capital, but capital is so cheap that it makes sense because the payoff could be really big in 5 or 10 years. And the cost is very low because the cost of capital is very low. So growth companies, and especially high growth companies, were good investments in the zero interest rate environment. And they ran way up, and there was a lot of activity in that type of investing. And there was a lot of money chasing those high growth because money was so cheap. Now, as money is getting more expensive, those type of investments don't look as attractive. Because if you figure, okay, my payout is in 10 years, but in the meantime, I'm paying 5, 6, 7, 8% for this money, I'm losing money on a compounding basis until that hopeful payout 5 or 10 years from now. And so if just using the rule of 72, if my cost of capital is 7% and I invest $1 million, I'm going to have to get $2 million in 10 years just to break even. This is going to have to be a double. So it becomes very risky when interest rates are high. So those high future growth type of companies that don't generate cash right now have really been hit in the stock market. And whereas they had done really good in 19, 20, 21, and we had been beneficiaries of that. We since sold off those type of companies, but our portfolio still has a bit of a growth tilt, so it really affected our portfolio. So we got rid of the growth companies, we raised cash, but apparently not enough because our portfolio has taken a hit this year. So in this type of market environment, it makes more sense to stay away from those high growth companies. What's more attractive and what the market has been rewarded is companies that don't require a lot of capital but generate a lot of cash flow. Okay, so those like a dividend payer and these companies that maybe they're not growing as fast and you're not investing in them for the future potential growth, you're investing it for the cash flow today. Those companies are more valuable in a higher interest rate environment. So we're in the process of shifting the composition of the portfolio more towards that. The other thing that makes sense, and how to explain how interest rates affect economic activity. So if interest rates are 0 or 1%, and let's say you're an investor with a lot of money, with millions of dollars, and that money's sitting in the bank making 0 or 1%, would you be happy with that? No, of course not. You want to get that money out of there to put it into something more productive, because almost anything is more productive than 0 to 1%. So you're looking at all kinds of growth opportunities and investment opportunities, because you don't want your money making 0 or 1%. But what if all of a sudden interest rates are 8 or 9% at the bank, sitting there safe without you having to do anything or take any risk? Well, you're not that interested in desperately looking for the next investment opportunity, because you're perfectly happy making 8 or 9% with no risk and not doing any work, right? So all of a sudden, that slows the economy way down because there's less investment activity. And not only that, when interest rates are 0, not only you want to invest all the money you got, you also want to borrow money and invest even more, right? Because if you could borrow at 0 or 1 and invest it at 5 or 6 or 7 or 8, there's a huge spread. Or even at 4 or 5, it makes sense. So 0 interest rates stimulate a lot of economic activity. High interest rates really slow down the economic activity, because it makes people comfortable sitting on cash, and it makes people not want to invest or borrow in order to invest, right? So, and as they slow down that economic activity, people lose their jobs, and then the labor market gets back into balance. So we're looking for companies that generate current cash flow. We're not looking so much for future growth because it's too expensive. And the other thing is, we could invest money for 6 months and make 4.5% without taking any risk in U.S. Treasuries, and so that becomes an attractive alternative. Okay, so we're going to include that in the portfolio as well. And so I mentioned that here's another example, that mortgages have gone way up, and I didn't think they would get to 7%. I did a video a few months ago, and I said, I don't see mortgages getting to 7 or much higher than that. Within a few weeks, they got to 7. But they didn't stay there, and for the reason that I mentioned in the video, that if mortgages got to 7%, investors would love to lend money to people at 7% for a secured first mortgage. There'd be all kinds of investors wanting to give people money at 7%. And there would be very few people wanting to borrow money at 7%. There'd be this huge influx of money to invest it, to lend at 7%, and there'd be very little demand for money to borrow at 7%. And that's what happened. Mortgages went up to 7%. They stayed there for a very short time. Now they're back down to about 6.25%. Because there's no need for it to be at 7, because everyone will want to lend at 7 and no one will want to borrow at 7. So I don't think rates are going to go to 7 or 8 or 9 or 10%, because for that very reason, no one would want to borrow at that rate and everyone would want to lend at that rate. Okay, so, but I think rates are going to stay in that 4 to 5 range for a while, until the demand destruction comes in and people start losing their jobs because companies start going out of business. Unfortunately, that's what it's going to take to fix this this structural labor shortage that we have in this country, in the absence of loosening up our immigration policy or laying off government workers. So that's the backdrop that we're going into to choose to decide where we choose to invest. And not high growth is not such a big priority. Current cash flow is a bigger priority. So that understanding of where the economy is going will impact how we allocate the portfolio, and you'll see changes in the portfolio as a result of that. So we'll stay in touch and let you know what we're seeing and what we're doing and what changes we're making, and through the end of the year we'll get another year-end recap before the end of the year, and we'll do our best to stay in contact. If you have any questions, reach out to the office, and we're here trying to keep a pulse on what's going on so that we could do a good job for you. All right, so have a great day.